Now, financial repression is a topic for a more in-depth presentation, but as 2012 confirmed, financial repression has become the unmistakable policy of governments worldwide. We'll be hearing much more about this policy over the coming years. According to Bridgewater, the frequency of protests, strikes, and social unrest increases sharply as soon as annual public spending is cut by more than 3% of GDP. The unrest is appearing globally. In Greece, where the government has attempted to implement austerity measures, there's a 20% unemployment rate in the 30 to 50 age group and a 58% youth unemployment. Greece's homeless rate has risen 25% since 2009, with 20,000 people living in the streets of Athens. Suicide rates, violent crime, and HIV infections are all rising quickly. This is what happens when society begins to break down because of debt. Youth unemployment is exceptionally high in most countries, especially the United States, which further burdens its young people with crippling student loans. Rising crime rates are another symptoms of the increased stress currency devaluation causes. This chart on incarceration of inmates since the removal of gold, we can see the rapid rise in crime since 1971. Despite the government job reports that put unemployment at 7.8%, those who have stopped looking for work after years of failing go uncounted. As soon as unemployment benefits run out, a job seeker is no longer registered as unemployed by the official figures. We can see that the job participation in the United States is plummeting, due in large part to the aging population and outsourcing. When we take into account the lack of participation, as shadow stats figures show, we see real unemployment in the U.S. is over 20%. Financial repression involves restrictions on bank lending practices, which dries up available financing and stifles economic growth and development. This is a subtle form of nationalization, as it discourages investment abroad. A more obvious form of nationalization comes as restrictive trade laws. One example is the U.S.'s Foreign Account Tax Compliance Act, or FATCA, enacted in 2012 with the cooperation of 50 countries. This makes it much more difficult for Americans to hold investment funds based outside the United States. Larger government and further nationalization of industry are aspects of financial repression policy. In the United States, distressed financial institutions, automakers, and healthcare are coming under the control of government, especially under the Obama presidency. Most of the new jobs created are government jobs, with 500,000 U.S. government employees making over $100,000 per year, twice that of the average U.S. worker's salary. Financial repression is becoming a global policy as the currency war amongst countries like China, Russia, and the United States accelerates. China has been using financial repression since 2000, with the official inflation rate pegged at 0.72% from 2002 to 2009. This creates negative real interest rates of minus 7.2%, which gives China some of the lowest real interest rates in the world and explains why it is such a large buyer of gold. Negative real interest rates can be determined by subtracting real inflation from official inflation or real interest rates. There's a direct correlation between gold buying and negative real interest rates that are encouraged by financial repression. Negative real interest rate, despite government's incessant promises of economic recovery, will likely be with us for years to come. This policy rewards borrowers but punishes savers. Currency debasement, which results from creating too much currency and is one of the elements of financial repression, is surreptitious in that the public is less aware of the damage. Inflation caused by currency creation is the hidden tax. Everyone who eats, drives, heats their home, or sends their children to college is aware that life is becoming more costly by the day. Yet the government continues to use inflation figures that show the cost of living is stable. They have achieved this deception since the days of Bill Clinton through creative accounting, such as removing food and energy from the basket of goods used to measure inflation and the CPI. Before 1995, the CPI measured a fixed standard of living with a fixed basket of goods. Today it measures the cost of living with a constantly changing basket of goods, measured with metrics that are themselves constantly changing. Fortunately, economist John Williams of ShadowStats keeps track of the original basket, and his figures show inflation at a more realistic level. Last year saw several important BRICS and Asian agreements that exclude the US dollar. In March 2012, Brazil, Russia, India, China, and South Africa agreed to development banks that will allow these countries to trade amongst themselves without using the US dollar. In 2012, China also signed important agreements with Brunei, Cambodia, Indonesia, Laos, Malaysia, Myanmar, Singapore, Thailand, Vietnam, and the Philippines, which are all members of the Asian Alliance. They will trade in yuan rather than US dollars. China and India are rumored to be circumventing Iranian trade sanctions by trading gold for Iranian oil. The foreign appetite for US treasuries is also waning, and the Fed is subsequently being forced to buy US Treasury debt. It is expected to buy up to 90% of new debt created in 2013. This situation creates restriction on available treasuries, which will continue to push down absolute yields. The developing world has had enough of the U.S. economic domination that has been enforced since the 1944 Bretton Woods Agreement. OPEC's backing of the U.S. dollar in 1973, which required oil to be traded only in U.S. dollars, stopped the greenback's rapid slide that began when the gold peg was removed 2 years earlier. As the developing world continues to find ways around this petrodollar arrangement, the U.S. dollar will find itself in serious trouble as its weak fundamentals rather than its reserve currency status are used for valuation. The Federal Reserve currently holds about 18% of U.S. debt on its books, a number that could bulge to 28% a few years out, depending on the continuation of or increase in the current programs and the growing distrust in U.S. fiscal responsibility. Many private investors are pulling out of the markets and are even showing distrust in gold proxies, such as gold shares and ETF shares, in favor of the most trusted asset, physical bullion. By one estimate, physical demand will likely exceed ETF demand by 5 times. This is almost a complete reversal from a few years ago, when ETFs accounted for 80% of the demand. Backwardation occurred in the gold price in 2012, which means that the physical price exceeds the futures price. This indicates a stronger interest in physical over paper gold. Backwardation is a rare event in gold, as physical gold is one of the most liquid forms of money. Much of the world's gold still exists and is available at the right price. Last year, 2012, began with slow gold coin sales. However, November saw the greatest volume in 14 years, probably influenced heavily by Obama's re-election, which guaranteed more spending and more debt. Perhaps the most significant consequences of runaway debt is that central banks have been net buyers of gold for the past 3 years, beginning in 2009. According to GFMS, in 2012, net official sector gold purchases totaled 536 metric tons. This is up 17.4% on the year. These figures do not include China's central bank buying, which in the past occurred secretly through Chinese sovereign wealth funds that do not require the same degree of transparency central banks do. We know that China, as a country, bought more gold by August than the European Central Bank's entire 501 tons of gold holdings. This past year saw significant central bank buying from countries like Brazil, Iraq, Mexico, Thailand, South Korea, and the Philippines, as well as by established buyers like Turkey, China, India, and Russia. In fact, central banks bought more gold in 2012 than they have since 1964. Germany's call for repatriation of some of its gold from the United States and France is another indication of the monetary role central bankers are anticipating for gold in the coming years. Some gold watchers like James Sinclair feel this is a game-changing event and another example of loss of confidence in the U.S. government. When Venezuela demanded the return of its 160 tons of gold from the United States, it took only a few months to acquire. Why does Germany have to wait 7 years for the U.S. Fed to deliver 300 tons? One obvious answer is that the gold is not available at this time. Although the United States is monetizing its debt through the Fed's purchase of treasuries, Japan is even further along this road, and we can learn about the future of the U.S. economy by looking at Japan's example. Japan, which has the worst balance sheet of any of the world's developed nations, has survived partly because it is self-funded and less dependent on foreign bond purchases. Japan's death rate now exceeds the birth rate. The population is aging and retiring, and therefore the Japanese public are becoming bond redeemers rather than bond buyers. As well, Japan's relationship with China has soured significantly over the Japanese government's decision to nationalize the Senkaku Islands, which the Chinese claim as their own. The Japanese auto industry has suffered significantly, and Japan has not recovered from the Fukushima nuclear disaster caused by the 2011 tsunami. Because of these developments, Japan's central bank will buy 56% of the country's issued treasury bonds this year.